Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. Today in this seminar on management accounting class, there would be a presentation from Group 13. And first of all, I'm Eva Alia, and I will be the moderator today. I would like to thank our lecturers, the Honorable Mr. Iwayadi and Ms. Bita Rahayu, and also all of the Zoom participants that is able to present today. And for the presentation, Group 13 consists of Bakri, Olivia, and Rapoto Fao. And time is yours.
All right. Thank you, Mesa, for letting us start already. So our presentation today consists of lean accounting, target costing, and balance scorecard. Can you please move to the next slide? Sorry. So here is a table of contents. So during this presentation, our group is going to describe the basic features of lean manufacturing, also describe what is lean accounting. Also, we are going to explain the basics of life cycle, cost management, and target costing. And finally, we are going to discuss about the basic features of the balance scorecard and its role in lean manufacturing. Next slide, please. Okay, so first of all, I'm going to define what is lean manufacturing. So it is actually an approach that is designed to eliminate waste and maximize customer value. Next slide. And when we talk about lean manufacturing, we are going to talk also about lean manufacturing systems, which allow managers to eliminate waste, reduce costs, and become more efficient. About the dimensions of lean manufacturing, we are talking about two dimensions. The first one is about delivering the right product, and the second one is about cost reduction strategy. So in the delivering the right product, we are talking about the right quantity, the right quality. So we are talking about zero defect, also at time needed and at lowest possible cost. And when you talk about cost reduction strategy, it actually redefines activities that are performed. Let me mention that there are 5 principles of lean thinking, and our group is going to explain one by one about it. So the first one is precisely specify the value by each particular product. The second one is identify the value stream for each. Third one is make value flow without interruption. The fourth one is to let customer pull value from producer. And finally, the fifth, the last one is pursue perfection. So the first one is value by product. So if we define it, it is actually when only value added features should be produced and when non-value added activity should be eliminated. The second one is about the value stream, which is all activities. We are talking about both value added and non-value added that are required to bring product group or service from starting point to finish product in hands of customer. When we talk about value stream, we have to talk about the types of value stream first. There are order fulfillment, and the second one is new product. And we also talking about some activities that we perform during the value stream. So there is the non-value added. So here we are talking about activities avoidable in the short run and unavoidable activities due to current technology or production method. And the second one is value added. Here we have steps of order fulfillment value stream. So here it's about the moving materials, quality management, engineering, also setting up equipment, maintenance, etc. So there are some steps. So we go from the sales, and then there is the order entry, also scheduling. Then we go to the purchasing steps, then production planning, also support activities, seller manufacturing, and then packaging and shipping, also the billing customer and collecting cash and receivables. So finally, we arrived in the post-sales services. So order fulfillment actually provide current products to current customer. About the value stream mapping, it is actually a good way to show what is value added and what is not, and how much time it takes to perform various activities. It is also simply a method of drawing out the entire manufacturing process. So we reveal the flow of a product and how much time it needs to move through the various steps of the value stream. About the value flow, actually, it changes the traditional manufacturing setup for batches to a cellular approach in order to first reduce setup time and also reduce changeover time. So when we talk about setup time and changeover times, actually, the lean manufacturing reduces the time in order to configure equipment to produce a different type of product. And thus, it will enable smaller batches in greater variety to be produced. So it also decreases the time it takes to produce a unit of output, thus increasing the ability to respond to customer demand. About the P value, as you can see here, the lean manufacturing actually uses a demand pool value system where the production is triggered by the customer order, as opposed to a push system where production is triggered by forecast. So that's all for my presentation. The next slide will be explained by Olive. Olive, time is yours.
I'm sorry, Olive, you're still on mute.
All right, thank you, Linda. For the next topic is about pursuit perfections. As the process of becoming lean begins to unfold and improvements are realized, the possibility of achieving perfection becomes more believable. This can be realized by the first is source of waste. To achieve the objective of producing the highest quality, lowest cost products in the least amount of time, a lean manufacturer must identify and eliminate the various forms of waste. Waste consumers research without adding value. Waste is anything consumers do not value. Elimination of waste requires that its various sources be identified. The second is employee empowerment. In a lean environment, increasing the degree of participation increases productivity and overall cost efficiency. Managers seek workers' input and use their suggestion to improve production process. Third is total quality control. Poor quality supply cannot be tolerated in a manufacturing environment that operates without inventories. Simply put, lean manufacturing cannot be implemented without a commitment to total quality control. Total quality control is essentially a never-ending quest for perfect quality. The striving for a defect-free product design and manufacturing process. Fourth is inventories. Overproduction of goods is controlled by letting customers pull goods through the system. Inventories are lowered by cellular manufacturing, low setup times, GIT purchasing, and demand pull system. 5. Activity-based management. Process value analysis is the methodology for identifying and eliminating non-value-added activities. Process value analysis searches for the root cause of the wasteful activities and then over time eliminates these activities. Next. Next is about lean accounting. Traditional cost management may not work well in the lean environment. In fact, the traditional costing and operational control approach may actually work against lean manufacturing. Standard costing variance and departmental budgetary variance will likely encourage overproduction and work against the demand pull system needed in the Standard costing variance and departmental budgetary variance will likely encourage overproduction and work against the demand pull system needed in the manufacturing. Next. Okay, for the focus, value stream, and traceability of overhead costs, the focus is to allow overhead costs to be assigned through the driver tracing of costs in a lean accounting system. as we can see in Exhibit 16.4, provides a visual summary of value stream cost assignment. Most of the cost items can be directly traced to the value stream. The only allocation used regularly is facility costs. Facility costs are assigned to each value stream using a cost per square foot, total cost divided total square feet. If a value stream reduces the square footage it used, it is assigned less cost. Thus, the purpose of this assignment is to motivate value stream managers to find ways to occupy less space. As space is made available, it can be used for new product lines or to accommodate increased sales. Next. Next, product costing. Because of multitask assignments, cross trainings, and redeployment of other support personnel, most support costs are exclusive to a focused value stream and are thus assigned to a product using direct tracing. One consequence of increasing directly traceable cost is increased accuracy of product costing. Directly traceable costs are exclusively associated with the product and can safely be said to belong to it. Product cost is calculated by taking the cost of the period and dividing by the output. Next, limitation and problems. There may be some individuals working in more than one value stream. The cost of these shared workers can be assigned to individual value streams in proportion to the time spent in each stream. For example, a payroll clerk may support several value streams. In this case, the clerk's salaries should be split according to the time spent processing payroll for each value stream. However, even in the most ideal of circumstances, there will be some individuals who will remain outside any particular value stream. The plan manager, for example, that will assign this cost to value stream poses the same challenges as assigning them to multiple products in the traditional production setting. And finally, having a value stream for each product is not practical. The usual practice is to organize value streams around a family of products. Next. Value stream costing with multiple products. The costs are assigned proportionately when multiple products are produced with multiple products. Product costs per value streams are calculated using the actual average cost. To know value stream product cost is we can get total value stream cost of period divided with units shipped of periods. Next. As you can see in Exhibit 16.5, for example, during the week ending April 10, Robert Auto Parts produced and shipped 1,000 units of Model C and 40,000 units of Model B. For a total is 5,000 units. Using e-cost information from Exhibit 16.5, the total value stream product cost is $1,600 divided with $5,000. So we can get $120 for the average unit cost for the steel wheels value stream. Next. Value stream reporting. The costs are collected and reported by value stream, outside costs reported separately. Exhibit 16.6, it shows a profit and loss statement for the plan for the week ending April 10. The plan had significantly increased its sales of steel wheels to auto manufacturers that were replacing low and aluminum wheels with steel units on new models. Costs outside the value streams, sustaining costs, are reported in separate column. The revenues and costs reported are the actual revenues and costs for the week. To avoid distorting the current week's performance, inventory reductions are reported separately from the value stream contributions. Adding the inventory change also allows the income to be stated correctly for external reporting. So that's all about my explanation. For the next topic will be explained by Fahri.
Okay, thank you, Alif. I will explain about decision making. may lead to the first short-term decision and may not reflect long-term consequences. Using the average product cost for a value stream means that the individual products cost are not known. In reality, the fully specified and accurate product cost is not needed for many decisions. Waste can be eliminated at the activity and process level without knowing product cost. We do not need detailed variances by product to signal sources of waste and potential for improvement. In fact, as already noted, standard costing variances may actually impede improvement decision. For example, special order and make or buy decision can be made at the value stream level. The next is about performance measurement. Lean accounting replaces standard cost system measurement with a box scorecard that compress the first operational, second capacity, and third financial metrics with prior week performance. A metric of financial and non-financial measure are used. Abounding a standard cost system also remove a major operational control system, and it must be replaced. The lean control system use a box scorecard that compare operational capacity and financial metric with prior week performance and with a future desired state. The future desired state reflect a target for the various measure operation. Non-financial measures are also used at the sales level. A typical value stream box scorecard is shown in Exhibit 16.7. Metric and format can vary. Weekly actual product cost is reported in a box scorecard with the target state being referred of 3-month rolling basis. We can see this Exhibit 16.7. The box scorecard compares see the last and this week and plan future comparison measure point to future desired goals. The next is about the implementation. A survey conducted recently by Association for Manufacturing Excellence suggested that more than 50% of US manufacturing companies are working to introduce some level of lean manufacturing into their plan. Although the concept of lean thinking can be applied to all aspects of a company's operation, until recently they have been implemented mostly on plant floors. Value stream maps are a useful tool to visualize the sources as waste in the manufacturing facility. With value stream maps, it's very relatively easy to identify inappropriate producer, overproduction, waiting, moving, unnecessary inventories, and so on. This identification helps the company to design better production producers to eliminate such wastes. How does the lean thinking apply to a service business? Similar to manufacturing companies, the root cause of waste in service company resides in the functionally organized batch and point processes. Therefore, the logic of identifying value stream that span across functional boundaries, building work processes that mirror to those value stream, and using a pull approach to determining the level of output with customer demand is equally applicable to service business. Again, value stream map provide a viable tool to help identify the sources of waste in the operation of service company. That's all our presentation. Back to moderator. Thank you.
Okay, thank you, Fahri, and thank you for Group 13 for delivering such informative information. And next, we will move on to the question and answer session. So especially for Group 14, feel free to ask to the presenter group. You can type in the question in the chat room, or you can just unmute your microphone and ask directly. And to other groups as well, you're free to ask, guys. And after that, we will wait for several minutes for the group to answer the question. Okay, we can see some questions. Okay, so first we have question from Maria, and the question is related to Exhibit 6.7. Can you please explain the meaning of units per person, one-time delivery, and dock-to-dock days? And from Nazif, can lean accounting be applied to non-manufacturing companies? And from Nelson, how value stream costing and with multiple products are formed? Can you give more details about it? And also from Shakila, related to your slide 15, can you please elaborate the kind of perfection that the lean manufacturer seeks? There's also from Elfa, from Wilda, from Mutia. So there's many questions coming in, and we will give the time for group 13 to think about the answer. Okay.
Okay, I will try answer this Maria question as about uh exhibits 6.7 that you're presented. Can you please explain the meaning of unit per person, one-time delivery, and dock-to-dock days? Okay. Uh, for the operational measure, the have a three uh, the first is unit sold per person is a partial labor productivity measure and is therefore a measure of labor efficiency. Second is dock to dock is the time it takes for a product to be manufactured from the moment the material arrives at the receiving dock until the finished product is shipped from the shipping dock. And the last, first time group as a measure of quality and is simply the percentage of product that made it through production without being defective and thus needed to be rejected or reworked. Okay, uh, okay, Maria.
Okay, thank you, Fahri, for the answer.
Okay, I would like to answer a question from Wilda. The question is, could you give more details about what the value of product is to customer stated there? So the value of product to customer is the difference between realization and sacrifice. Realization is what the customer receives, and sacrifice is what the customer gives up for the basic and special product features, quality, brand name, and reputation. Value thus relates to specific product and to specific features of the product. So, Wilda, have you satisfied with the answer?
Okay, thank you for the answer, Olivia. I'm satisfied and I got the point.
All right.
So I'm going to answer Nazif's question. So his question was, in your opinion, can lean accounting be applied to non-manufacturing companies? So in our group opinion, I would say yes, lean accounting can be also applied to manufacturing areas because it is a body of knowledge that is used to continuously improve processes and deliver value to customers. So yeah, it is not, even if it has a lot of overlap with the industrial engineering and quality in the engineering, it is not only for manufacturing areas. Yeah, so as an example of it, we can take this as example of product design, which is non-manufacturing areas, but it can also, how to say, yeah, we can also apply the lean accounting in it. I don't know if Nazif, does it answer your question? Okay, all right. Thank you, Nazif, for your question. I'm going to answer Farhan's question. So thank you for the materials that you have prepared presenting group. Can you please explain the implication of cellular manufacturing in the value flow? So actually, when you talk about the cellular manufacturing, it is a type of value flow that is also in the topic of lean manufacturing. So since lean manufacturing uses a series of cells in order to produce families of similar products, so it actually has a system that replaces the traditional plant layout with a pattern of manufacturing cells. And then for that, there is a cell structure that is chosen over departmental structure because reduces lead time, decreases product cost, improves quality, and increases on-time delivery. So through that process, the manufacturing cells contain all the operations in close proximity that are needed to produce a family of products. And then there are some machines also that are used that are typically grouped in a semi-cycle. So yeah, for that, there is the reason for locating processes that is close to one another. And through those steps that I mentioned before, it will help to minimize the moving time and also to keep a continuous flow between operations while maintaining the zero inventory between any two operations. So yeah, the cell is then used in order to dedicate the producing products that require similar operations. Farhan, did I answer your question?
Thank you, Linda. It's clear. I get the point.
Okay, my pleasure. Thank you.
Okay, I will answer the Julius question. Julius answer. What happened to the financial statement of a business under a lean approach? As a company implement the lean approach to doing business, the financial statement often show a temporary hit to the profit. Traditional manufacturing produce large amount of inventories, which carry the cost of material, divert labor, and overhead. Okay, that's all my answer, Julius. You satisfied? Okay, thank you, Julius.
All right, I would like to answer a question from Alpha Yulinis that is related to the slide 10. The question is, can you explain the concept of order fulfillment value stream? So the order fulfillment value stream focuses on providing current products to current customers. It includes the receipt, movement, and transformation of materials from the time the customer purchase order is received until the time the product is delivered. The order fulfillment process typically involves receiving goods, short-term storage in a warehouse in the distribution center, customer order processing, picking and packaging, and shipping and logistics. So, Alpha, have you satisfied with the answer?
Thank you, Olivia. I got the point.
All right, Alpha.
I'm going to answer Nelson's question. Thank you so much, Group 13, for this presentation. I have a question related to your slide 19, how value stream costing with multiple products are formed. Can you give more details about it? Thank you so much. So, wait. Related to your question, Nelson, so value streams costing with multiple products are actually formed around products with common processes, as you can already see through the illustration on the slide 19. So through that, manufacturing cells within the value stream are structured to make a kind of family of products or some parts that require the same manufacturing sequences. So yeah, the costs are assigned in the same way as for focused value streams also. Did I answer your question, Nelson?
Yes, Linda, thank you. I got it.
Okay, thank you, Nelson, for your question.
I would like to answer a question from Nadia Sosabila. The question is what the advantage of successfully implementing lean manufacturing? Thank you. So the successful implementation of lean manufacturing has brought about significant improvements such as better quality, increased productivity, reduced lead times, major reductions in inventories, reduced setup times, lower manufacturing costs, and increased production rates. So that's about the answer. Nadia, have you satisfied with the answer?
Okay, thank you, Olive. I got the points.
You're welcome, Nadia.
I'm going to answer Shakwila's question. So thank you for the materials that you have prepared. Presenting group, I have question related to your slide 15 about pursued perfection. So can you please elaborate the kind of perfection that the lean manufacturer seeks? Thank you in advance. Okay, thank you, Shakila, for your question. So in order to answer your question, by meaning the pursuit perfection, actually the lean manufacturer is seeking zero setup times. So we're talking about zero defects, producing on demand, increasing sales production rates, also minimizing costs and maximizing customer value that represent the ideal outcomes. So this actually can be realized in part by eliminating waste first, and also by increasing employee productivity, also by committing to total quality control, also reducing inventories, and finally by identifying and eliminating non-value added activities. Did I answer your question, Shakwila?
Yes, that is quite clear for me. Thank you, Linda, for the answer.
Okay, thank you for your question.
Okay, the next I will answer the Mutiara Putri Hefra question. Mutia Putri Hefra. I want to ask what happened to inventories of a business under a lean approach. Okay. Under the lean approach, inventories are kept at the minimum level. As a result, the costs associated with inventories are moved from the balance sheet to the income statement, reducing the net income. One way to alleviate this negative outcome is to report the financial impact of changes in inventory level as separate item in the income statement of value stream. The separate item indicates to management that the financial impact is temporary. Okay, Mutia can understand what my answer? Okay, thank you.
Okay, I think all of the questions already answered by group 13. Back to the moderator.
Okay, then thank you, Olive. So if there's no question left, I think this is the end of the presentation of Group 13. Thank you so much for delivering good presentation and also to answering the questions from the participants. And I think it's all for today. Sorry for my mistakes. Good afternoon. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.